Hey everyone, welcome back. So, the IRS just announced the new federal income tax brackets for 2026, and it's going to affect just about every American household in some way. These updates might sound technical, but they're actually a big deal for your wallet. They determine how much of your income is taxed at each rate, how much you get to keep, and even how much you can save in accounts like your retirement plan or HSA. And here's something a lot of people don't realize. These aren't just routine adjustments. They're shaped by a mix of inflation and new rules written into the one big, beautiful bill. So yeah, that means the way we calculate our taxes next year is going to feel a little different for millions of people. All right, let's get into what's changed. So, starting with the big headline, the IRS has officially released new income tax brackets for 2026. These apply to income you earned starting January 1st, 2026, and will be reflected when you file your taxes in early 2027. The structure is still the same. We've got 7 tax rates ranging from 10% up to 37%, but the income ranges for each bracket have shifted upward. That means more of your income will be taxed at lower rates. For single filers, the 10% bracket now covers the first $12,400 of taxable income. The 12% bracket then applies up to about $50,400. The 22% bracket reaches just over $105,700. Then we move up to 24%, which applies to income up to around $201,775. The 32% bracket kicks in up to $256,225, and the 35% bracket goes all the way to about $640,600. Anything above that is taxed at the top 37% rate. For married couples filing jointly, the thresholds are roughly double that, which is pretty standard. You'll pay 10% on your first $24,800, 12% up to around $100,800, 22% up to $211,400, 24% up to $403,550, 32% up to $512,450, 35% up to about $768,700, and 37% on income above that. For heads of household, the bracket ranges sit in between, and the standard deduction for that group rises to $24,150 in 2026. So what does that really mean for you? Basically, these increases give you more breathing room. Let's say you earn around $100,000 as a single filer. In 2025, you might have been closer to the upper end of the 22% bracket. But now, that same income stays safely within that range, saving you a bit on your total tax bill. It might not sound like much, but those little percentage differences can really add up. Even a small shift in a bracket can mean a few $100s more in your pocket, and for households juggling higher grocery or utility costs, that matters. The IRS said these changes reflect inflation adjustments, with about a 4% bump for the lower brackets and roughly 2% for the higher ones. That's their way of preventing what's known as bracket creep. Basically, when your wages rise to keep up with inflation, you don't want to be pushed into a higher tax bracket if your real buying power hasn't actually increased. Now, something that tends to confuse people when we talk about being in a certain tax bracket, that doesn't mean all your income is taxed at that rate. It's a tiered system. Think of it like stacking buckets. The first bucket is taxed at 10%, then the next chunk at 12%, then 22%, and so on. So if you're in the 22% bracket, that rate only applies to the top portion of your income in that range, not all of it. And I get comments all the time like, wait, if I make $1 more, do I suddenly lose thousands of taxes? And the answer is no. That's not how the system works. It's progressive, not all or nothing. So if you get a raise, you're not being punished. You're just paying a slightly higher rate on the portion above that bracket line. All right, next up, let's talk about one of the most important parts of your tax return, the standard deduction. This is the amount you can subtract from your income before the IRS even starts calculating your tax. For 2026, the standard deduction is increasing again. It's now $16,100 for single filers, up from $15,750. For married couples filing jointly, it rises to $32,200, up from $31,500. And for heads of household, it goes up to $24,150. That's roughly a 2 to 3% bump across the board, which may not sound dramatic. But remember, about 9 out of 10 taxpayers take the standard deduction instead of itemizing. So these increases directly reduce taxable income for the majority of Americans. If you're married and in the 22% bracket, that extra $700 in deduction could save you around $150 in taxes without you doing anything at all. It's automatic, you just get it. Now, if you do itemize your deductions, meaning you track things like mortgage interest, medical expenses, or charitable donations, these changes still matter because your itemized deductions have to exceed that new standard deduction for it to be worth it. So, as the standard deduction rises, fewer people find it worthwhile to itemize, which actually simplifies things for a lot of households. Speaking of simplification, let's move to some of the other updates you might not have heard about. The alternative minimum tax exemption goes up to $90,100 for single filers and $140,200 for married couples, with a phase-out starting at $500,000 for singles and $1 million for joint filers. That means fewer people will get caught by it next year. The federal estate tax exclusion rises to $15 million per person in 2026, up from $13.99 million in 2025. That means a married couple can now pass on up to $30 million before any federal estate tax applies. The annual gift tax exclusion stays at $19,000 per recipient, and for gifts to a non-citizen spouse, the limit rises to $194,000. The foreign earned income exclusion also increases to $132,900, up from $130,000 in 2025. The maximum adoption credit rises to $17,670, and up to $5,120 of that can now be refundable. Employers offering childcare can now claim a bigger credit too, up to $500,000 or $600,000 if the business qualifies as a small employer. A major change under the One Big Beautiful Bill. If you use a health flexible spending account, the limit goes up to $3,400, and the carryover cap increases to $680. The Earned Income Tax Credit also gets a boost, with a maximum EITC for families with 3 or more children now at $8,231, up from $8,046 last year. Meanwhile, a few things are staying the same. The personal exemption remains at $0, and the old itemized deduction limit stays permanently eliminated. The child tax credit is still $2,200 per child, and the SAL cap moves slightly higher to $40,400. For most people, the big takeaway is that the 2026 brackets and deductions mean slightly less tax owed on the same income compared to last year. And in an economy where prices are still high for rent, groceries, and healthcare, even a little relief counts. So then, what should you actually do with this information? First, once 2026 begins, make sure to check your paycheck withholding. Employers will update to the new 2026 brackets, but still a good idea to use the IRS withholding calculator to make sure you're not overpaying or underpaying throughout the year. Second, if you're self-employed or run a small business, make sure to update your estimated quarterly payments early next year. Once the 2026 brackets take effect, your projections might need a quick adjustment. It's also a perfect opportunity to think about your retirement contributions for the new year. When tax brackets move upward, it changes how much benefit you get from pre-tax contributions to 401ks or IRAs. And since the IRS hasn't released the 2026 retirement limits yet, it's safe to assume they'll go up a bit too, giving you more room to save tax efficiently. Lastly, if you've had a big life change, marriage, a new baby, buying a home, or a job change, these updates can all shift your overall tax situation. It's not just about the bracket you're in, it's how everything fits together. So yeah, while these new numbers might look small on paper, they can have a meaningful impact when combined. A few $100s here, a few $100 there, and suddenly you've got more breathing room at the end of the year. What I always tell people is that understanding the tax code isn't about memorizing numbers. It's about knowing where those numbers can work in your favor. And right now, with the 2026 brackets officially set, you've got a great window to plan smarter. before the new tax year begins. So what do you think about these changes? Do they feel like real relief, or do they just keep pace with the cost of living? Let me know in the comments. I really want to hear how these updates hit your situation. And if you found this helpful, make sure to like and subscribe. I post these updates to keep you informed and prepared without all the complicated jargon. Because at the end of the day, the goal isn't just to pay taxes, it's to understand them well enough that you keep as much of your hard-earned money as possible. Thanks for watching, and I'll see you in the next one.